Short-term rentals has been such a big thing for a lot of people.
Yes.
Is there any tax rules or intricacies that we should be aware of?
Yeah, absolutely. So short-term rentals have been really popular, and we're about to find out part of the reason why, in my opinion. If we go back to the real estate professional status and the fact that all rentals are passive, well, there's a carve out under the definition of rentals activity in the tax code. And that was originally intended when the rules were written back in the 80s for hotels and motels. It's become known by the real estate community as the short-term rental loophole. It's called a loophole because you generally aren't able to do this easily with a single family property or a regular condo, but now you can thanks to Airbnb and VRBO. But if you rent your property out for an average stay or an average guest stay of 7 days or less, then it's not a rental activity. It's treated as another, just any other business, effectively. There's another exception too that's somewhat popular, and that's if the average stay is 30 days or less and you provide substantial services, which are things like daily cleaning, daily meals, tours, concierge, things that you would find in a hotel. If you meet one of those two exceptions, then it's a business. And with businesses, you don't need to qualify as a real estate professional to use the losses to offset your W 2 income. The problem is in most businesses, if you have a loss, you actually lost money. But here you have a single family residence, for example, the same single family residence as before. And now you have this massive loss from depreciation. And all you have to do to turn that non passive to offset your W 2 or active business income is materially participate. And you don't need to spend more than 750 hours. You don't need to spend more than half your total working time. There's 7 tests, but 3 of them are usually going to be the ones that matter for the vast majority of investors. And as you spend 500 hours on the property working on it, either that or you do substantially everything yourself, which means you're a one person show. You run the whole thing. Maybe you have some very little ancillary help here and there. And then the third one is you spend more than 100 hours and no one else spends more time than you. And that's by far the third one I just mentioned, by far the most popular because it's hard to spend 500 hours, at least from what I've seen, on a short term rental. But you could probably spend more than 100. And then you could also use cleaners and like have a repair person come down and do some things. As long as they don't spend more time than you, then it's non-passive for you. So this has been known as the short-term rental loophole because again, you could go around this blocker that the Tax Reform Act in 1986 put in, and basically take the losses as non-passive without qualifying as a real estate professional.
Well, these all of these strategies that we've talked about here, this is why it's important to talk to a real estate investing tax CPA, somebody who is seeing this on a regular day. You mentioned you've helped hundreds of companies here now with this process. I would imagine that a general CPA, somebody who's just an everyday business oriented CPA, they probably don't have this level of expertise.
Yeah, they typically don't. The reason for that is they're looking at a wide array of different things very broadly. So they might be helping someone in manufacturing. They might be helping someone who has a small business. Maybe they're a doctor, maybe they're an attorney, but they don't ever dive deep into the real estate aspect of it. When it comes to the tax code, the real estate part is probably the most in depth or one of the most in depth. And people just don't really, they scratch the surface and never really dive deep into it. So a lot of times we hear stories like, why isn't my CPA ever told me about this? And people are somewhat skeptical. So we have to start pulling out the tax code and the citations and all of that. But yeah, most generalists are not going to know the stuff. And if they do, if they are aware of it, they typically don't know how to properly apply it, which is sad because we've seen a lot of investors leave a lot of money on the table. I think one of our largest clients, we ended up saving like legitimately like $3 million for them because they had such a big portfolio and no one's ever told them, hey, you could do this. And yeah, it's unfortunate.
Well, I think one of the things that we've experienced and is the fact that, we're talking to more general CPAs. We kind of expect to have some sort of maybe strategy sessions or some way to discuss some of these things more in detail to make the best use of your time, our time, and everything with our acquisitions. And more times than not, that feedback just isn't there.
Because the problem with it is most CPAs, there's a few problems. So the first one is most CPAs are simply tax preparers. So you give them the information, they file your tax return, and they say, I'll see you next year. And that's because they're very busy doing tax returns. They take on way too much work than they can handle, and they're always scrambling to get it all done. Another reason is so they're never giving you tax advice. It's kind of a different skill set. It's kind of like more consulting versus, sitting in the background. And that's also partly because many CPAs, not all, are tend to be introverted, and I've worked with many who prefer just to sit behind the computer and never talk to anybody, and they're very happy doing that. There's nothing wrong with that. I'm just saying this is why a lot of people aren't getting the advice, because the combination of just being too busy, not really knowing how to administer the advice, not diving deep enough in the tax code to even realize this stuff exists. So that's usually why you don't see tax advice being given to a lot of to a lot of taxpayers in general.
No, I really appreciate this. Before we switch into the rapid fire questions, is there a question or concept, anything that we should have tried to cover here today so far?
I think we were relatively comprehensive here in terms of the big picture items, the real estate professional status, the short-term rental loophole, how to play the passive activity loss game, just understanding even if you can't use reps, even if you can't use the short-term rental loophole, just investing in real estate, whether you're doing it passively or you're building your own portfolio, you're putting yourself in a tax advantage position. Those are the main concepts. And if you tack on just the long-term benefits again of being able to refinance out and being able to 1031, I think if you're able to use those things, you're putting yourself in a very good tax position as a real estate investor.
Well,